So I wanted to give you another overview of this for this week as the financial institutions and risk. And once you get the book, please read the first 7 chapters. I mean, it's mostly an intro and just basically an overview by industry. And then chapter 7 is really the first chapter regarding specific material over background. And in this chapter, we basically talk about the specific risks. Um, and now these risks are not actually risks unique to financial institutions, but we're going to look in general in our focus at financial institutions. And we'll also look at regular companies. But these are basically the main risks that I mentioned in the prior video: interest rate risk, market risk, credit risk, off balance sheet, foreign exchange, country or sovereign, technology, and operational liquidity and insolvency risk. And there's actually a few more I will mention in another video that I think in the current environment where there's a lot of changes going on right now, as you know, and many industries are being disrupted. There's environmental regulation, compliance risks, license to operate risk is a new arena right now that is going on where things are changing very rapidly in the current business environment. And I'll do another video for you guys to update you on some other risks that are very much current. So interest rate risk, as we'll go over in chapter 8 and 9, which will be at the second half of September for us, is basically a mismatch between assets and liability maturities. So it's basically, for example, say your assets are collecting rate at 5%, but your liabilities needing to pay interest at 7%. It's pretty much the interest rate risk that, you know, they could, once interest rates rise or change, then you could be out of balance. So balance sheet hedge via matching maturities of assets and liabilities is problematic for FIs. So the mismatch with the maturities is that the idea is that if you have assets and liabilities maturing at the same time, you're totally balanced. If it's not, then you're going to have exposure to the mismatch. And we'll look more into that in detail in the coming chapters. Credit risk is basically, we're talking about firm-specific credit risk, basically somebody not paying, defaulting. Systemic credit risk is when the whole system could potentially default. And we've seen a lot of that in 2008. I actually had experience working in structured finance and with CDOs back in 2007, right before the financial crisis. And definitely was in that world of assessing credit risk and, you know, with the mortgage-backed securities and going through that. So if you stop by office hours, if you want to chat about that, I'll be very happy to connect about that. And Lehman Brothers failure was actually my firm's client back then, and definitely heard a lot of the inside stories of what's going on. But the idea is that back in the financial crisis, that firms simply borrowed too much. They borrowed too much, and they were highly leveraged. Lehman Brothers was leveraged 1 to 30, which means that they basically had a very low threshold of assets, of their own assets, and the rest was borrowed assets. You know, so they were financing their business with borrowed assets, and once those assets had gone wrong, had gone bad, they were in trouble. It's just, think about it this way: you decided to buy an amazing property, but it's a $3 million property, and you borrowed all the money except you put down 20 grand. As soon as that property goes down in value, even by 1%, by 30 grand, you're already underwater. And that's basically what happened to Lehman. It wasn't that they even lost that much money. It's just literally the asset value went down by 1 or 2%, and that was enough to basically make their company worth nothing on the equity side. And talk about credit risk. There was definitely a lot of credit risk there. And as you see in this chart here, this is where all the charge-offs happened. For commercial banks, it was actually in 2000. Looks like it's rising in 2008, 9, and peaking in 2010. This is for credit card loans. In terms of the default rate, was quite high here. Real estate loans, went up also quite a bit, to almost 4%, and you could see that that's much higher than usual. As growing credit risk, of course, with loans being more accessible to more companies, more people, there's more and more risk, and screening and monitoring. Of course, banks and rating agencies do that in a little bit different ways. Funds, asset managers are basically charged with this. Diversification is a big thing. That's a big thing with securitization in general, is breaking up the credit risk in smaller pieces and making it non-concentrated is a very powerful tool to reduce credit risk. And then banking structures. I know Dodd-Frank is now again being possibly regulated upon in Congress, so we'll see that. But regulation has a lot to do with it, with some of the controls in place for bank structures and credit derivatives. As there was some issues back a decade ago with them, but I think the idea is actually very sound in terms of writing insurance policies and acquiring insurance policies on the outstanding credits that one owns. Can really you can really with the right due diligence, of course, in place, can really hedge out a lot of your credit risk.